Hey everybody, it's the Investor Professor, and let's talk about what's going on with the Japanese bond market and what this means for U.S. investors. So recently, the bond yield in Japan has soared to 3.14%. Now, this is the highest that they were able to sell bonds for in decades. This surge was triggered by a failed 20-year bond auction that has been the weakest since 1987. Basically, what this means is that investors they were trying to sell bonds at 3.4%, which would be a really good deal, but investors didn't buy. So what does it mean when a country is trying to sell bonds, which is, remember, a bond is you're selling the debt, right? The debt repayment. If a country is selling their bonds at a mildly 3.14%, that's not bad, and investors don't buy. So what's happening in Japan, they're having what's called a liquidity crunch. The Bank of Japan is reducing its bond purchases itself, having to do with the inflation that's hitting them, up 3.5% as of April, the end of April. Now, this is actually the highest inflation for them over the last 2 years, and the central bank, just like our Federal Reserve, is getting pressure to raise interest rates. Now, we don't want our Federal Reserve to raise interest rates, but in Japan, they have a central bank that regulates their interest rates, and they are getting pressure to raise interest rates. So why this matters to U.S. investors, and particularly U.S. businesses, is that Japan is a major holder of U.S. securities and treasuries. And Japan, so what's going to happen is that if Japan starts to increase their interest, then the Japanese investors are going to start selling off their U.S. assets and start investing domestically, because now it's a higher return. See, before, Japanese interest rate was very low, so they were able to borrow Japanese money and invest in U.S. stocks or U.S. businesses and recoup that return in between. But now, if the Japanese interest rate is increasing, then they're going, well, it's not as cheap to borrow money from Japan anymore. So analysts are warning that this is some sort of global market Armageddon. So basically, when countries that normally maintain lower interest rates, so therefore investors can borrow money at a lower interest rate and reinvest that money into other countries that produce more, and they're able to profit off the difference. Now, if that's not able to happen, the rich people are crying. And since we are a global market, this sort of chain is going to affect our businesses here and the global markets, which will affect our market, because investor sentiment has now changed. They know that they're not able to go to a country like Japan, borrow money cheaply, and get their money value increase here in the US, because now the money's more expensive. It kind of messes with their margin of error. This is your Investor Professor here. Like, follow, and share. And this is a reminder of how global events and global markets will have an effect on our American consumers and our American investors. We always have to keep our eye out on what is going on globally, because it does have an effect. Now, the effect may not be immediate, but there will be an effect. Just like a tidal wave, it will eventually hit our shores. Like, follow, and share.